Hey everyone, welcome back to the channel. My name is Leo, and in this video here, we're going to take a look at Exxon Mobil. You've heard of this company, huge mega corporation for oil and energy. So we're going to load it up in our software here and do an analysis. If you're new here, welcome. We're going to do a value investing approach on this company to see what this company is worth and what you should be paying for it. So without further ado, let's roll the intro and jump into Exxon. Alright, so we have Exxon Mobil loaded into our research tool here. Now, they're making headlines because of the tragedy that's going on between Ukraine and Russia. They are actually pulling out their investments out of Russia, which is huge. They've been dealing with Russia for such a long time, but now the economic sanctions being put into place. CEO from Exxon Mobil is actually saying that they're going to be pulling out of Russia. So we've been seeing a little bit of a rise in stock price because of this. But good for them. Don't support any violence. And if they were to continue operations in Russia, that's just blood money. But I'm going to leave politics out of it. Let's see what this company is worth. And let's just go through the numbers here quick by looking at the company metrics. So just doing a quick comparison. We're hovering around a 5-year average PE. EPS is improving. ROE, return on equity, is also improved over the last 5 years. Profit margin slightly above our 5-year average. Revenues at 280 billion, net income 23 billion, free cash flow of 36 billion, with our average free cash flow of 14 billion dollars. Improvement there, phenomenal. Now, with the dividends paid, it's 668 million with a 4.32 dividend yield. Now, I know this company got hit hard. If you look over here at the 10-year mark, okay, let's see. Yeah, there's that lovely drop right over here. COVID hit. That dividend yield was skyrocketing. I know they were taking on debt, but they still didn't cut the dividend. Pretty sure it was double that amount. So with an Altman Z-score of, sorry, I skipped over the return on invested capital here. I mean, they can easily cover the dividend, so that's a positive. Return on invested capital is at 9.69%, and our 5-year average is 3.30. Huge improvement there. I'm liking that. But 5-year average is not too great. Almond Z-score, it's almost at 4, which is phenomenal. We want that over 3, and Piotrowski score is 8. That's phenomenal. We want that between either 8 or 9. 9 being the highest score you could possibly get, so that's phenomenal. See that? I keep saying that a lot, and I apologize, but I get excited when companies are doing well from at least a metric perspective. Going into our financial evaluations, we are scoring this company at a 7. Now, the discrepancies lie within our current ratio, return on equity, as well as our 5-year return on invested capital, which we briefly touched upon here on the company metrics side. So our current ratio is, we're not going to get any points there because we want this to be over 1.5. Now, granted, I know for sure they took on a lot of debt during that whole downturn when COVID first started. So this number, it's not the worst current ratio. We want this to be 1.5 and higher, but at 1.0 there is enough assets on hand to cover the liabilities. So not the worst, but it is somewhat worrisome. Return on equity, we want this to be over 15% ideally. Now, granted, it's an oil company, it is a commodities industry. I'm not trying to make excuses for the company, but I don't expect this number to be incredibly high to begin with. Their entire market and business model is based upon this liquid commodity. Long story short, not too impressed with that, but I don't completely blame them. Now, our 5-year return on invested capital, though, I want this to be over 10%. We're almost there with our trailing 12 months number, but overall, the last 5 years has been 3.3%. Now, that indicates to me that Exxon Mobil is not getting a great return on, obviously, their capital that's invested. So it's a little bit of a discrepancy there. Now, granted, those are 3 points here that I mean, I can't say that they can really fix this just because of the industry that they're currently in. This can definitely be fixed, granted, if whoever's managing their capital. And current ratio, they got to just bring their debt levels down, and so in order to evoke a more higher current ratio to be above that 1.5 threshold that we're looking for. But 5-year PE average, phenomenal. We want that we want that under 22.5. We have that. EPS growth, phenomenal. 400% growth. Debt to equity, it's actually low considering by a considerable amount. We want that under 50%. We have it at 24.72. So a lot of points being awarded here. In share dilution, even though it's a small decrease in share dilution, it's still a point. We want this number to be decreasing or staying the same, ideally decreasing, and Exxon Mobil is doing that. Granted, the only time it might be a discrepancy is if they're buying back shares if they're overpriced, which we'll find out shortly. If it's underpriced, or undervalued rather, then that's a good thing. Net income growth over the last 5 years has been improving. 5-year free cash flow growth also been improving, and as well as revenue. This is a large company, folks, and it's still moving, it's still growing, obviously at a slower pace, because it's what, $343 billion company. Okay, it's still it's still making waves, just in a slower fashion. But yeah, their debt levels here showing in the current ratio. Return on equity and return on invested capital is going to lose points for me. But you know what? The big red flag would be the current ratio. I want it to be over 1.5, as I said, because debt levels, no matter what you do, like that'll kill you. So we want the debts to be super low. Let's move on to a price analysis to determine an applicable price to pay for this business. The numbers are all over the place with Exxon Mobil due to the whole COVID-19 shutdown, no one flying, no one driving, just the oil prices essentially going into the negative numbers. This company got hit pretty hard, and it's reflected in these numbers here if you look at them. Over 59% growth in 1 year. 5-year average is 9.52. 10-year average is 10-year growth is negative 1%. These numbers are all over the place, but like I do in all my other videos, I'm going to make sure I'm conservative as possible to assume the worst and expect the best out of this business. And if you're liking the video so far, make sure you hit the like button and the subscribe button. Helps out the channel a lot. Makes me feel warm and fuzzy inside. I feel like that's the catchphrase. Warm and fuzzy inside, because that's how I feel when you guys hit the button. Alright, so with our revenue growth, I'm going to be super conservative and go with a 7, 8, and 9 revenue growth. I'm ignoring this number here because that's just a complete anomaly. Anomaly? I can't speak today. I don't know why. Profit margin. I'm going to hover around... So 3, 5, and 8. I wouldn't be surprised if we... Okay, so if we go 3 for the low side, 5 for the middle, and 8 for the high side. How about that? We can hit those numbers. Actually, you know what? I'll just do 6. That's something that could definitely be a hit. Free cash flow margin. 4, 4, and 12. So let's do 3. Let's do 4. We can do 4.5 for the high side. Price to free cash flow. Let's do 9, 10, and then 12. Actually, we'll do 8, 10. We'll do 8, 10, 12. And then PE ratio, we'll go 10, 12, and 14 because on a 10-year analysis, we should be paying a lower multiple for this business. Now, with the desired return, I always do 13%, folks. And here it is. Our average calculation is $57 for Exxon Mobil if you wanted to make a 13% return over the next 10 years, assuming these numbers are correct. Now, granted, second thoughts about these numbers here. These might be a little bit more liberal than I would imagine. I would potentially even change that to a lower multiple, or a lower number of 6, 7, and 8. So it decreases it slightly at 51. With our earnings multiple calculation checking off on this evaluation at $93. Our average calculation, folks, is $51 by valuing these all the same. From our conservative, we have 28, 52, and 74 on the high side. Now, full disclosure, I own this company. I bought in at around, I think my average price is $40. So I am hovering around in this range. Granted, I do think at the time, I'll be fully honest, I do think I overpaid for that value, for what it was currently worth based off the numerics. Because I went off the premise of, okay, this is all noise. This whole crash here, all noise. I know that we're going to probably come back to these numbers eventually. My biggest question is, okay, how long am I willing to wait? I don't think oil is going away for the next 100 years, personally. And we're going to need oil for a lot of other things. So my principle was, yeah, I might be overpaying for the value at $40 here based off the numerics of the company at that time, but I know that they will grow into those numbers, considering it's at $51 now and I paid $40. So at the time, yeah, but you know what? It eventually grew into those numbers, and now we're sitting at around $80 a share, $81 at the time of recording this video. So, with that being said, I don't know where this company is going to go in terms of once they pull out of Russia and how that's going to affect future growth, because Russia was I guess a decent player in their portfolio, but I'm guessing that the CEO taking that stance probably believes from an economic standpoint that they can afford to pull out of Russia and do like economic ventures elsewhere. But those are my thoughts, guys, on Exxon Mobil. Do you own this company? What do you think? Once again, I'd like to ask you to like and subscribe if you haven't done so already. Leave a comment down below. And yeah, I will see you in the next video. Thank you so much for watching.